Welcome to Sachs Realty's Tuesday Night Podcast, where we talk about anything and everything real estate. Each week, we deliver expert information enabling you to make better informed decisions while keeping more money in your pocket. If you're interested in real estate, this is your show.
Hi, everyone. Welcome to another Tuesday Night Podcast. We gave Todd the night off tonight, so Ron and myself will be with you this evening. I'm Melissa LeVie. I'm here at Sachs Realty, and joining me tonight is a real estate agent with Sachs Realty, Ron Trzcinski. Ron, introduce yourself.
Hello, I'm Ron Trzcinski. Some of you have seen me a couple of times. I've been on here. But yes, Todd has taken off. I don't know. He's probably swimming in the ocean or something. Who knows where he is? But he deserved the night off. And so here we are. We've got a few questions that have already come in. But I think we're going to start off with Melissa's going to tell us some more doom and gloom. Yeah, the economy's headed that way. And then we'll try and talk about some of the positives that might be out there in the economy.
Yeah, I mean, we don't really, the focus is not to be doom and gloom, but I mean, you guys know it's not very happy news all the time right now. Every day it seems to be something news real estate wise that, it's not super positive. And one of the topics we're going to discuss tonight is that a lot of you sellers feel that you want to move, but you can't move because sure, there may be great deals out there, but you're locked in at a super low 2 to 3%, 4% rate. And why on earth would you risk losing that? And that's what we're reading about a lot in mainstream media right now. And Ron, I know that you have heard this as well from some of the sellers that you're dealing with.
Yeah, well, some statistics that you found, what is it, like about 92% of homeowners who have mortgages that are under 6% right now. And then there's a large percentage, and I don't know if you have that in your data there, that is in the 2 to 3% range. Obviously, the 2 to 3% range, people are the ones who really are thinking twice about making a move. But one of the things that has also happened in the last few years is not only has the interest rates going up, the value of properties has gone up. And in fact, I'll give a little bit of data on that. This is anecdotal because it's Maryland, but I think it's representative of what's going on in the nation. In just from 2019, the price of properties in Maryland has gone up by nearly, it's on the back page here, 40%. In 2019, it actually did not go up in value. It actually had a slight decrease. But then we started really going up in price. We went up by 9.3% to 2020. In 2021, the price had gone up by 11.3%, 8% in 2022. And then now in 2023, it is kind of plateaued where we're at about 0.7%. And I think that even though for Marylanders, that's good information. If you're around the nation, that's anecdotal information that's going to be somewhat similar to what's happening in most of the country. So if you bought your home in 2019, you're not going to typically see 40% appreciation. And I think the nationwide is actually a little bit higher than that. Mm-hmm. So if you did sell your home, even though you give up that high interest rate, you've got a little bit more money than you normally would have to play with. Maybe you can use some of that money, to either, to have less of a loan on the next place or to buy the interest rate down a little bit.
Right.
And I know this next statement won't help completely as far as interest rate goes. But if you're looking at your taxes, then the higher the interest rate, the higher the deduction you have. If you're upgrading, you're probably paying higher property taxes. So there again, you have something else that's a higher amount to deduct on your taxes. So if you're in an income bracket where you can actually use that, then that's of value. If you're not in that kind of a tax bracket, then it doesn't matter. In the end, yes, you're still going to pay more money. But I think you want to look at all of your finances, including your taxes, when you're deciding, do you buy or do you not buy or upgrade or to the next place. On the other hand, if you're going to downsize, might be the time to do it. Because, like I say, houses seem to have plateaued, and sometimes people try to predict when is the right time to sell, when's the right time to buy. Well, when you're selling, when the prices are at a plateau, that's when you want to sell. If you can, and if everything else lines up. So, and of course, it depends on where you're moving. Which I also have some data that shows that, like, if say you were going to retire and move to Florida for that retirement, a couple of markets in Florida, Miami and Tampa, are actually showed some very high increase. Now, I'm looking at just, that's a month over month. Well, actually, what I'm looking at in Florida is this is from the Case Shilling study. It shows February, so for some reason they're slow on getting March's data. The data I gave for Maryland was from March. There were like 10% change increase in Miami and a 7% increase in Tampa. Atlanta was a fairly high increase also at 6.6%. Overall, the nation increased nowhere near those amounts, but with the Case Shiller report, they look at like 20 major metropolitan areas. Most of them increased. There were a few that did not go up in value.
We do have, I see you guys, all your comments and questions coming in, and we're going to address some of those right now. We did have a super cash chat coming in from Tom Kine, Todd, and I'm going to send this one over to you, Ron, since Todd is not here. Can you help negotiate a 40% disrespectful offer for me here in Maryland? Thanks.
If you're still online and you can tell us, I'm going to guess that you are the seller and you have an offer that came in at like 40% low, or came in 40% of what you're asking. Let us know if that's the direction you're going. And if that's the case, that you are the seller, we are in a hot market. So because there's so little inventory, so things are selling pretty quickly. I don't know if you're getting other offers. You could, just see what else is going to come along. But generally, you don't just out of hand get rid of an offer, even if it's ridiculous. You can go back to them and give. It's so low that it's hard to say that you'd even counter. Like, say you were at 500 and they came in at 200,000. It's hard to say, oh well, I'll do 475. Doesn't make much sense. But if they came in ridiculous, go back with a ridiculous offer to them, or ridiculous counter. Say, thank you for the offer. We will consider your offer with the following changes. Purchase price $600,000, and the other conditions the same. They'll of course come back and say, wait a minute, you're only asking 500, and you'll say, yes, we're asking 500, not 200. So I mean, if they're disrespectful, you don't have to get angry at them, but obviously they don't deserve a positive response.
Yeah, that was my question. If you had an offer come in so absurdly low, do you ever just, ignore that? I mean, do you definitely address it? What would you recommend?
There are people who will try to, some people think, oh, the market's going to crash. Has it crashed yet? Or are people still asking ridiculous prices? Well, unfortunately, prices haven't come down yet. It hasn't crashed. Will it? I don't know, but it hasn't. And even if it does, it isn't going to crash 40% overnight. Mm-hmm.
And let's talk about those interest rates. I mean, for those sellers that are holding on right now, thinking that they're on the sidelines and they're like, I'm going to give it another 12 months. I mean, I know Todd and I talk about it a lot, that we really don't see those interest rates going down, at least anytime soon, certainly not to the 3% range.
There was and I forget who did it, but someone did a study. Now, it's going to be based on opinion rather than on actual facts, but let's say it's the facts based upon what people's opinions are. They said they tried to find out at what value would you start to buy, and it looked like 5% was that magic number. Wasn't 5.5, wasn't 5.25. If you get around 5%, yeah, that's enough of an incentive where we're going to get back out in the market. Again, if the money is there, whether it's because you have a lot of equity in your house and you can use that to buy the rate down, or you can go to the seller of the place where you're going. If they're not getting the house to move too quickly, if you can ask them, are you willing to help pay this rate down? Maybe you can get the rate closer to that amount.
Yeah. And I see Brad, you said hi. Hi, Brad. We had another comment here. I'm in Connecticut and ready to move to South Carolina or Florida and don't know what to do. Can get a great price for our house, but not going to pay the current interest rates on new mortgage.
Doesn't look like you want to move.
Yeah. I mean, what would you say, Ron, to someone right now who is like, the market is strong in many, many parts of our country. Would your recommendation would be to sell now?
From the selling standpoint, yes, this is the time to sell. And now this is my offhand knowledge of Connecticut versus Florida, but I think the Connecticut market is probably hotter. Prices are probably a little higher than they are in the Florida market. I don't know exactly where you're going, so I can't, or what type of house you're looking at. Mm-hmm. If you're downsizing, then you're probably paying less by moving into Florida. And when the price, if prices come down, they're going to come. Eventually, you'll see them come down everywhere. So you'll make a little. If you sell later, you make less money on your house. Say you pay less on another house. Interest rates come down. Well, will the price of homes come down? If interest rates come down, probably house prices won't come down.
Yeah. Yeah, I hear you on that. How about this one? We got Cameron Jenkins asking, Ron, what happens when unemployment gets to 10%?
That probably means the country has moved into a recession. But regarding that, and I know there's been lots of reports to get into the news about companies laying people off, especially in the tech field. Over the last 12 months, there have been like 300,000 people who have been laid off from major tech companies, Microsoft, Google, and the like. But at the same time, the question is, where are those people going? Well, one of the things that's happening, and actually I found this kind of amazing, Google, even though it's a tech company and they laid people off, not everybody is in a tech position. For instance, of some of the layoffs that they did in January, 30 of those layoffs were actually massage therapists. Now, of course, it was Google, so I guess you expect that. But it's not like they're getting laid off and now what are they going to do? Go take a job at Walmart? Well, I don't know where they're going to go, but they're probably not making the same salary as the software engineer. The software engineers, there's a study that also was done by some of the hiring tech companies out there. Within 90 days, the majority of the people who have been laid off by these companies have found new employment, and many of them have found new employment that is in the same field and for more money than they were making. I'll give you anecdotal information. When I was working in industry, I left a larger defense contractor and went to a subcontractor. From the defense contractor, I was one among many engineers. When I went to the other company, I was someone who had all hats as the quality manager at the company. So, and I was able to make more money by making the change. And the same thing can be happening to these people. They're one of many at the larger companies, Facebook, Meta, whatever they are, Google, Microsoft and such. they go to smaller firms, they've got a much larger role. And I have seen, well, just for instance, somewhat local to here, in Herndon, Virginia, there's a software development company, and this speaks to commercial space also. They just increased their commercial space. They doubled it because they're growing by that much. There's a company in Denver. They just purchased another company. They're part of the Microsoft supply chain for software products. They purchased a company and they are hiring. They're in Denver. So it's these smaller companies that, if they hire 50 people, it doesn't necessarily get in the news. But you add all these smaller places up that are all around the country, and then you say, okay, that's where those 300,000 people went. So yeah, if 10% employment came along, we'd be in a bad situation, but we are not near that yet. And in spite of these big layoffs that we've been hearing about in the news, unemployment numbers have not been going up. And apparently these people are finding pay-wise similar jobs. So we're not even seeing, from that standpoint, a decrease in the wages.
Talking about the commercial space, just because it's in the news and we don't have to really deep dive into talking about commercial, but just on Sunday, there was Bed Bath & Beyond had filed for bankruptcy protection. And then also in the news, Footlocker was going to close as many as over 400 stores, but also a lot of those stores are in malls and they are transitioning to a new concept store. What that exactly means, details will come, and if you do know, please comment. The same as Bath and Body Works, that as well, they're pulling out stores from malls. So it seems to be that there's going to be a new type of store, however that is, the layout on what these companies are going to. Do you know anything about that, Ron?
I don't know exactly which way all those stores are going. I know in some cases what's happening is people are buying things online, so they don't have to go to the actual store and see the product. Personally, I still like to go and see some of the things if it's something I haven't used before, get an idea what I'm actually buying instead of just buying randomly online. But locally, right up the street from us, there was a mall, was Hunt Valley Mall. It was indeed a mall. The main time that it saw any kind of traffic was when people from the businesses in this area, and there's quite a few offices and manufacturing companies in the area, people would go up in the lunch hours. So somewhere between 11, 1 o'clock, the mall would be crowded, especially in the food court. Other times of the day, you went in there around 5 o'clock, you say, where is everybody? The mall wasn't making it, and then theft started to move in. So it reinvented itself. Parts of it are a mall, but for the most part, they had some box stores move in. They had a movie theater. They had several restaurants move in. So it's more like an open air retail space now. And actually, speaking of that, there's a local commercial real estate company in the area that just raised close to $250,000 worth of dollars to make acquisitions of mainly open air retail space. So for these places, these malls that aren't making it, those stores may be moving to these open air type of retail places. Kind of way it was, I guess, 50 years ago before the malls came about.
Right.
I kind of like the idea of the mall. You can shop in there with any kind of weather, but
it is true though. The malls used to be packed, and now even when I even remember going in for Christmas time, and I was shocked on just the ease of parking, the no waiting in lines. It's just completely transformed. So yeah. I mean, they'll be getting creative.
But yeah, and a particular firm that has raised this capital, already over a third of their money, they've already made acquisitions, and they're making acquisitions around the country, some in Baltimore, of course, because they are a Baltimore firm, but they are purchasing in Chicago, Illinois, Troy, Michigan. They have some places in Oakland, California. They have purchased in Atlanta. So they are purchasing the open air concept. They generally like a grocery store to be the flagship company for those places. Usually there's a big some big store that is the draw, and then the other stores feed off of that bigger store.
Yeah. Yeah. We did have a question here from Maria. So agent listed house at $350,000, but agent says it will go for $375 to $425 during the open house. But write an offer based on what it is worth to you. What would you do as the buyer?
Which agent said the listing agent says it will go for more, or the buyer's agent? I assume the buyer's agent is saying it's worth more.
Yeah.
I would, if the buyer's agent is providing evidence that it is worth that higher amount, I would probably want to go in at that higher amount. However, one of the things that you can do, provided they don't tell you something like, we don't want any of these, is use an escalation clause. So if the price was whatever, was it $325 or whatever, go in at the asking price. If nobody else makes an offer, you say, we're giving you what you want, but be willing to escalate up to a higher amount. The unfortunate thing about seeing those houses is it misleads some buyers. Some buyers can't afford that higher amount that it's apparently worth, but they're misled. It especially happens on auctions. An auction house will always be listing a house at a lower price than they even intend to accept. So I don't like when they do that. It misleads the buyer into thinking, oh, look at this place I can afford. You'll see some mansion and it's listed at $100,000. You say, yeah, right.
Yeah. I just had a question here for you, Ron. This one is from AB. What if your area, 60% of sales were investors like the Atlanta suburbs? What can we expect to see in areas that have been investor heavy and hedge fund heavy?
Investors are typically going to buy, well, it depends what kind of investors we're talking about, but if they're investors who are going to renovate, then if they're going to renovate, they're going to buy it low and resell. So if you did a distribution of the properties, you typically will see a binomial distribution of a like kind of houses, like townhouses or detached homes. But if you have an area that's up and coming, so to speak, on the low end, you'll see where the investors purchased, there'll be a binomial distribution. And then you'll see on the other end where it's been renovated and homeowners, the homeowner occupants are going to be purchasing them. That'll have its own distribution. In fact, if you were to get that data and look at it, you should be able to see something like that happening. But if you want to buy in that area, I guess there's a couple of things. One is, are you buying it in a renovated stage? You're going to probably pay the higher amount. If you're buying it in the other, there are going to be houses in those neighborhoods that are somewhere in between. So you are probably looking at a house that maybe needs a little bit of work. So you're not buying something that the investor buys at the much lower price, but you're not buying something that the investor's already renovated. So you still need to do a little bit of work to it. Which is another thing as far as affordability of homes goes. If it does need some work, you can come in with a renovation loan, like an FHA 203K. So you can you maybe can get a house at a lower price than it might normally be going for. Probably you'd win out on a bid because you'd probably pay a little more for it than, or could pay a little more than an investor, because an investor, their whole point is to make money with the deal, whereas your intent, I'm assuming this, is to move in, not to resell it and make a profit. So you have a little bit more room to play as far as price goes. You could go in a little higher than an investor. So you could win the deal to begin with. You could have it renovated using an FHA 203K loan, and end up with something that probably was less overall than if you purchase the renovated property. But it depends what you're looking to do. There's different ways you can go about buying in that kind of neighborhood.
Just to follow up on that second part of the question, what can we expect to see in those areas that have been investor heavy and hedge fund heavy? What do you think will happen to those areas, like in the next, let's just even say 12 months?
Well, that's what I was saying. Where you would, it depends what kind of area it is. But like I know in Baltimore, there's certain neighborhoods, Baltimore City especially, where investors are buying and they're renovating the houses. As the houses get renovated, they then are selling at a much higher price.
Yeah.
So you see the one end, if you look at the distribution of the prices, here's the investor prices as they bought them. Here's the investor price as they resold them as renovated. So what I'd expect to see is a price increase.
Right.
Except it's a price increase with a reason. It's not because they just went up in value. It's because the neighborhood was improved, presumably, because the investor bought it with the whole intent of renovating the house.
Mm-hmm. And then we had real estate mindset. I just saw, Travis, where is your question? Here it is. So thank you so much. Great to see you every week, as always. Why do you think we are currently at a historically low mortgage default foreclosure rate?
The low interest rates, which is one reason. Incredible appreciation could be another reason. And for some people, if they were starting to have a problem, I guess there was some option to refinance. And some people have done that. And then, and this has been brought up in the past, unlike back when we had the recession in 2009, around that time, the laws have changed so that when you got if you got your loan after that period of time, back in the 2008, 2009 timeframe, when you qualified for a loan, you had to qualify for the loan to whatever it was going to adjust to. So if it was interest only to begin with, it was amortized over 40 years. If it was, adjustable rate mortgage, whatever it was, that to begin with, the price was low. If it was going to adjust, you had to be approved for the amount that it would adjust to. So people were still approved when it adjusted. People were still approved if they bought it like in the last 15 years, 13 to 14 years. Whereas prior to that, they weren't necessarily approved. And in fact, what people were doing, and it happens almost every time that prices start to go up out of whack like they have recently, people start to think, oh, they're never going to stop going up. So they think, I'll buy now, and when the price goes up by 50% by next year, then I'll just refinance to better terms. Of course, back in 2008, we had a recession, or whatever year the recession was, and prices didn't continue to go up. That's where we saw short sales, foreclosures, and so on and so forth all over the place. But the law changed. So there's less people who are put into that predicament. So that's the other reason, or at least one of the other reasons.
And thank you for answering that, Ron, and thank you for the question, Travis. We had another question here by Yvette. What are the implications of buying a single-family home as an investment property that has more rooms than what the city shows? Is there a way to remedy without knocking it down?
So the home has more rooms than
what the city, probably what the tax record.
Yeah, I assume the tax record is
showing. Right.
Well, it could be that somebody made some renovations to the house and did not get permits. I know that if you're renovating in the Baltimore area, you get permits for construction for two reasons. One, so an inspector can come in and make sure that everything was done properly, which you would hope would be the primary reason that they're coming in, safety type concerns. The other reason is so that that jurisdiction knows what has been done to the property, so that they can tax you more. Oh, you improved the property? Let's do something with it. I guess I'd have to see specifically what's going on with that particular house, but it's a good chance that it was modified and did not have permits pulled, and so without the permits, it didn't show up in the tax record. So you could always ask the seller if why there is a discrepancy, and maybe they can give you a better explanation for that particular house.
Yeah, especially if it's an older home. I think if something's dated.
Yeah, I mean the idea that they have more rooms is a little surprising.
Yeah.
Unless they add it on.
Right.
And then you'd probably see more square footage also when you look at the public record. But on the other hand, usually people are taking walls down because people like the open concept rather than they're putting walls up to divide things off nowadays.
Yeah. How about, we're just going to ask a local question here because...
well, we are local.
We are local. We had a question here from Mr. Hyde. Do you think Anne Arundel County will still be hot next spring?
Jay, what do you think?
Well, I lived in Anne Arundel County for quite some time, so it's always hot. I mean, you've got Annapolis. Anytime you're near water, I think it retains value, I'm going to say. And yeah, I mean, it's just a very desirable area to live. A lot of people want to live down there. And it's, I just feel it holds on to value. What do you think?
Well, I think there's a good points. I mean, Annapolis is a very high priced area, and that's not going down. It's kind of a nice little suburb of, it's there for its own purposes, but it's a good suburb of DC. And yes, the water is certainly going to keep the value up, especially the closer to Annapolis you get. The people like the Severn River, the Magathie River, and so on. And some other areas, I mean, maybe you get to the more northern parts of Anne Arundel County, and parts of it are not a lot different than some of the not as perfect Baltimore City locations, but they're not bad. And there's still plenty of employment in Anne Arundel County. A lot of the airport is there, and lots of companies have built up around the airport just for the convenience of being near the airport. Mm-hmm. So that's another thing that helps Anne Arundel County. And it also is a good alternative to more expensive counties like Howard County.
Yeah, and you got Jim Curtis here making a comment. I don't see the whole DC, Maryland, Nova area going down in price at all. Yeah, I mean...
Well... I don't see anything happening where the government employment, and not just government workers, but people related to job, like lots of defense contractors have moved in around the DC area. Mm-hmm. And well, defense is real strong now. I mean, if we don't use it for a war for ourselves, we use they're building for a war for somebody else. So there's plenty of work with those guys. Also in the area, what's very big is the health and bio industries. Of course, the Center for Disease Control is in the area. The National Institute of Health is in the area, and the hospitals that are in the area also feed off of that. In Baltimore, of course, you have Johns Hopkins, and down towards DC, you have University of Maryland, which is definitely very much into the medical end of things. So yeah, I agree with that. That market is pretty strong, and I think it will stay that way.
Yeah.
Hopefully it will. I've got a listing that's just going to go on the market next week, so right outside of DC.
Yeah. Yeah. How about, Ron, let's talk about the getting the payments for the mortgage. Victor Santos, my credit score is 795. So is that true that I'm going to have to pay more for the down payment and monthly payment to subsidize people with bad credit? And I know this has been in the news.
I have not heard that.
Specifically talking about that loan level price adjustment, the LLPA. Now, this is definitely, we're not a lender. And if any of you, especially Travis, if you've got some information on that, that would be awesome to chime in.
Have you been hearing that, Melissa?
Well, so there is definitely some, I think that if you had certain, if you had a certain credit score, that you would be able to get a discount rate or percentage. But again, I would need to know more details, but I do believe that if you have a higher good credit score, that you are going to have to pay more. But I would need to, refer to a lender for that to give the specifics.
Well, doesn't make much sense, does it?
No.
The higher your credit, you would think the lower your rate should be.
Yep.
And it seemed to me that a couple of weeks ago when you had, what was her name, Alyssa? And if she's listening, I don't want to have her name wrong.
Yeah, Alyssa Glatz, yes.
Yeah, so she seemed to indicate that the higher your credit score, the better your interest rate would be. Mm-hmm. Which also, by the way, as far as speaking of ways to keep your rate low, I like the idea that she had where we typically think put 20% down, so if nothing else, you can eliminate the mortgage insurance premium. But she suggested if you go to 19% down, it lowers the risk enough that you'll still get a lower interest rate, even though you still might have to pay the mortgage insurance premium. And the mortgage insurance premium is not going to be as much as you save from the lower interest rate. So something to think about. In fact, you could probably even call her if you're looking to get a mortgage, since she knows those kinds of things.
How about this one, Ron? Richard asked, is it better to assume a loan to retain better interest rates? What are the pros and cons?
Oh, you can assume a loan. I just wrote a little blog about that for VA loans because someone just purchased with me using a VA loan. He got the VA loan himself, but the idea there is, at least say we have a VA loan. A VA loan is assumable, and it can be assumed not just by a veteran. Anyone can assume a VA loan, although when you get it for the first time, you have to be a veteran. But if somebody had a VA loan at 3%, and keep that in mind when you're selling a house, it can be an extra selling feature if you've got that. If you do have an assumable rate mortgage, I know VA loans can be. Some other loans maybe can. You should check with your lender and see if it can be assumed. If you can use that as a selling point for selling your home, maybe you can even get more money for your home because you're saying, look, instead of paying 6% or whatever the rate might be, I've got a loan here at 3%. Yes, you need a down payment, but if you were going to put 20% down anyway, and that takes care of the additional equity that I have over what my mortgage is. You put that down and then pick up a loan at 3%. Maybe they're willing to pay a little bit more so that they can do that. They are assumable. To get into all the specifics, you'd want to talk to your lender for the loan that you have. Make sure that it is. Not all loans are assumable. Typically, government loans are assumable. Mm-hmm. Hopefully that answers it somewhat.
Yeah. How about we talk about this one from Robert? If the USA is so shell-shocked by 30-year mortgages, why not create a 5-year mortgage product to allow people to buy at a high rate but able to refinance lower down the road?
Well, you can always buy a house with your credit card. I think the interest rate would be extremely high if you were going to do something like that. Mm-hmm. In fact, it usually goes the opposite. Let's say you're going to buy a car. You could go get a car with a 5-year loan, but some people say, well, I'm not going to pay the high interest rate that I'd have to pay to get a car with a 5-year term. So they will get a home equity line against their house for even at today's interest rates for houses, if it was 7%, that's typically going to be better than what they're going to get for the terms for a short-term loan for buying a car. Actually, there are short-term loans that are shorter than the 5-year for hard money lenders, And of course, they charge outrageous rates. But then again, they expect you to turn the house around very quickly. So you're not going to very often see a hard money loan go more than 1 to 2 years. And if interest rates are 7 now, the hard money is 14% or more. So I don't know if so that is an option there if you want to go to a hard money lender.
Yeah.
I don't know. Do you think that's a good idea to try and get a 5-year loan?
I mean, if you can afford it, right? I mean, the whole thing is to get out of debt and to not be in debt. And we are in such debt as a country. If you can.
Well, another thing you can do is you get the 30-year loan, and if you were capable of affording mortgage payments that would have been with a 5-year loan, you get a 30-year loan, and the amount that the payment would be more if you had a 5-year loan, you just put that towards principal every month, and you'll end up paying it off in 5 years anyway.
Yeah.
And the benefit of that is that if you some month or another don't have the money to pay it off, or don't want to use the money because you want to go on vacation that month, you don't have to pay as much on that month. Mm-hmm. In fact, and some of the lenders that I work with will agree with this statement. If you have a choice between a 15 or a 30-year loan, they typically suggest to get the 30-year. If you want to pay it off in 15, you can, but it works better for you. You get more options if you spread it out over the longer term.
And let's see here. Oh, okay. Robert just did a follow-up. Thanks for taking my question, but it prevents you from having to be in a 30-year mortgage at 5 to 6% rate. I'll pay that 14% not to be locked in at 5 to 6% for 30 years.
Yeah, well, I'm not a lender, so I don't offer it, but if someone offers it, then yeah, sounds okay to me.
Oh, we got this question here for someone who does not know. Question, can you use a credit card to put a down payment on a house? Is that allowed?
It is, but keep in mind, as soon as you use that credit card, you've just changed your credit score and you've changed your debt to income ratio. So where you qualified for one thing at one time, as soon as you use the credit card, you've changed what you can afford. Is what most lenders say is once they qualify somebody, they say, now don't go buying anything. People are always tempted once they're qualified and they know that they got a house coming, they think, okay, now I'm going to start buying furniture for my house before they actually have the house. And then the lender checks their credit prior to settlement, and they say, oh, look, you just screwed yourself up. Or they go buy a new car, say, okay, I got the house out of the way, now let me get that car. So yes, you could use a credit card, but keep in mind it will impact the way your finances look to the lender.
Yes. And we can talk on touch on, Ron, is about the current situation of the buyers, especially the first time home buyers, because a lot of them have pulled out and put on the brakes for what's dealing with the current state of our market. And they're not, basically, the first time home buyer share of the market has dropped to 26%. Historically, the first time buyers made up almost 40% of the home buying market. So that's pretty substantial.
Well, several things that are possibilities for these people. I don't know how many, and maybe some of the listeners can tell us if they have this in their area. What Maryland has, I know some politicians push for this, but Maryland actually already has this, somewhat progressive. California probably does. If you buy a house in Maryland and you have a student loan, now there are certain conditions, but let's say you bought a house for $200,000, you can take up to 15% of the mortgage and take that towards the payment of student debt. So many of the people who are in this younger category are still carrying student debt, and that's one of the things that's holding them back from purchasing. But imagine, well, of course, 200 is hard to get a good house nowadays, but let's just use that from the number. You buy a house for 200, you can go up to 15% of that. So basically, we're talking about, I know somebody right now, they've got like $25,000 in student debt. That would easily take care of that debt, student debt, and allow them to get in a house at the same time. So that's one thing that's out there. One of the things I mentioned also is where you might get a home for a lower price, especially consider this as a first-time buyer. If you find a house that needs a bit of work and you don't necessarily do the work yourself, you might have to have some knowledge of what's going on because you'll want to coordinate what's going on as you use a renovation loan. But you're going to hire a general contractor who can do those types of loans. They can fix it up, and when you finally move in, it's like buying a nice new place. That's another option where you maybe can get something at a more affordable price. You can always ask the sellers to try and buy your rate down a little bit. If if their house is moving quickly, they might say, no, I don't need to do that. But if their house is moving a little bit slowly, then you can see if they will negotiate with you to try and get your interest rate lower. One of the things that's happening, and this is the thing that I mentioned about the student loan, that was a Maryland program. If you find a HUD-owned property, and of course it's a federal program, so this can be nationwide. If you use an FHA loan, the down payment is $1 or $100. I'm sorry. As compared to 3.5% that you would normally pay for an FHA loan. So assuming you had that money available, instead of putting it towards the down payment, you can put that towards bringing your interest rate down, which then makes your payments lower, of course. So there's just a few options that are out there where maybe you could get in. Other ones, and it may depend on your situation. If you're already in a family, you might not want to do this. But some people are buying multi-unit houses. So you buy a 2 or 3 unit house. If you got a 3-unit house and 2 of the units are bringing in $1,000 a month, good chance it's covering most of your mortgage, that $2,000 you're getting from the rent. And yes, it's not ideal for having a family in that type of house. But if it's your first house, if you have a family at all, it's probably not that big. And if nothing else, you now have invested money in something that's going to be bringing you additional income.
Right.
So
yeah.
That's another option.
Look at this question from Johnny Fly here. A realtor I know in Houston, let's say his name is Mavis, said that the housing is going to come down in price, but Redfin Data Center shows that home asking prices are higher than 2023. Is he wrong?
Well, I don't know specifically what's going on in Houston. The data from, that I did hear from, that Case Schiller did a report. Although it's not up much, the prices are up year over year by about 2% and by about 0.2% from, say, January to February. That's nationwide, looking at things as a whole. And when they look at 20 different markets out there, and Houston, of course, is going to be in one of those markets, one of the larger markets in the country, they might be one of the ones that actually is negative. I don't know where they are now. If Redfin says that they're still positive, then I guess they're still positive. But the stressors that are out there seem to be out there throughout the country. Which low inventory is the stressor that's bringing prices up. High interest rates is the stressor that's bringing prices down. And then I guess the other thing that's got people wondering which way to go is a potential recession. Mm-hmm.
And this also is talking about asking prices, not the sales price, but the asking price.
Right. If at any time in any market that you're in, almost any market, what you typically see is if you look at asking prices, you look at under contract prices, and then you look at the actual sold prices, it's the highest is typically what people are asking. Then you'll see, and you don't know what the end price is when you look at pending sales, but you'll see where it's listed at that time. It's usually lower than what it was when they were active, and then you see what it is when they sold, and it's typically a little lower. Even in the hottest markets, people start to adjust for those and keep trying to push their prices up. So there might change a little bit, but you'll maybe see like 4% of the 4% increase over what the asking price is to what the actual sold price is in the really hot markets. Generally speaking, no, you'll see each of those three numbers where it goes downward. So yeah, if in Houston we're just looking at asking prices, the sellers don't want to admit that prices are coming down. So they're still going to try for the higher prices.
Yeah.
Yeah. If he has access to the sold data, which I'm sure the real estate agent does, it's a little harder to get that off of the Zillow and Redfin type sites. But if you can get that data, then you can get a better picture of what's actually happening rather than what people hope happens.
Mm-hmm. And then, Ron, what do you think about this one? When is the buyer's market? Summertime?
Well, typically, more people put their homes on the market in the springtime, spring and early summer. And if that happens, just looking at supply demand end of things, you can say, okay, there's more supply, so that helps prices to come down a bit. Also, not all buyers, but a lot of buyers like to get that purchase done before the next school year starts, because they want to have their children enrolled in the school for the next coming year and for whatever their new home is going to be. So early spring or late spring, early summer may tend to be one of the hotter times for sales to take place. What I've seen when I've looked at the numbers, when you look at the winter months, and let's say starting November, December, January, there are less sales, probably about 75% of what you see during the rest of the year. So that's definitely not the hot time, weather-wise or market-wise.
Mm-hmm. But as far as it being a buyer's market.
Yeah, I mean, it'd be more of a buyer's market when there's more homes on the market.
Exactly.
Right. So it's like which, contrary to what some sellers think, let's put our home on the market in the spring and the summer. Well, now you put your home out there when there's more competition. So you've got more supply. They just added and more supply means prices come down. So that prices coming down is more of a buyer's market.
Mm-hmm. How about, you guys have lots to talk about tonight. We had this comment here. In our area, some prices have come down, and those are the ones that are selling. The ones with asking prices, like last year's, are sitting for a while having open houses.
Say that again there.
Yeah. So this is Starlet, and they are saying in our area, some prices have come down, and those are the ones that are selling. The ones with asking prices, like last year's, are sitting for a while having open houses.
Okay, well.
It's all about pricing properly, appropriately.
Yeah, and I guess, there again, some of the sellers just don't want to admit that prices are coming down, and they're going to try to still get the higher prices. I don't know if that includes builder prices in that, but builders are continuing to discount their prices. They're not discounting quite as much as they had been discounting, but they too are discounting their prices. Builders would prefer to give you options in the house instead of lower the price, but we're seeing those, the builders, bring prices down, and I wish I was seeing that with what I'm seeing.
Yeah.
Just looking at anecdotal evidence, I went with a client. We had 10 houses set up to see for the weekend. We added 5 over the course of the weekend because 3 of them went under contract before they even gave us a chance to look at them. And they'd only been on the market for 2 days. So you can imagine they were going at the asking price. Some people were still paying cash in the $750,000 range. So I guess it depends what market you're in as to, what's going on. And even in the, this is the Baltimore County that I'm talking about for the most part. But it's the type of house I was looking at that's where those buyers are. And it could be that this goes back to the idea of first-time buyers aren't buying. First-time buyers aren't going out and buying a $750,000 house because it's a first-time house. I mean, some of them might be, but
right.
They're in a lower price range, and those homes typically, well, they might be older, they might not be in as good a condition. It can be a little bit more volatile there, whereas the higher end market, those people have the jobs. And the
equity in their home too. I mean, a lot of those people that are, moving up could potentially, it's just a different, it's not your first time home buyer, most likely. Yeah. Okay. How about, what about this one, Ron? Eric Mings, what effects do you see on the real estate market with the government set to take over another bank, First Republic Bank?
Well, it's probably more outside of my pay range to answer that one adequately, but I don't think that we're at a point where we're going to have any big run on the banks just yet. And there's always banks, smaller banks taking over larger banks. I can't give a good answer on that. I can talk about it, but it'd be better if I was an economist instead of a real estate agent.
Right. Yep, nothing wrong with that at all. We have, how about this one? Jim Bob, hi guys, how does the direct construction worker numbers compare to the pre-GFC levels?
I don't know.
Yeah, I'm not aware of that one as well, on the numbers and how those compare. Yeah. So, and then we've got a direct report from Phoenix, Arizona. New construction prices for house in Phoenix, Arizona have gone up in the last few weeks.
Cool.
Also, number of houses under 300,000 in Maricopa County have gone down considerably. So
is that just giving us some information?
Giving us some information on, we love it when you guys tell us what you are seeing in your area. We've got a question here from Danuska. Good evening. Do you think that the government will come with incentives for first-time home buyers to help out the current declining real estate market?
Well, I don't know what the federal government is doing. I mean, in a sense, an FHA loan or a VA loan is an incentive by itself, but probably you're looking at local governments, local states coming up with programs. I know Maryland has programs to help first-time buyers and to help many buyers for that matter. And I'm sure that some of the other states have programs as well. Like some of the closing costs, some of the down payments can be taken care of by, well, I mentioned how the student debt can be forgiven by one of the Maryland mortgage program plans. They also have programs where you can get like $5,000 or $7,000, depending on what kind of job you have, taken care of in some of the closing help.
Yep. And then I'm just going to see, we are approaching 9. We have Brenda here. Brenda, thank you so much for chiming in. FHA lowered the MI mortgage insurance for the first time in forever.
Yes, absolutely. And on let's say a $300,000 house, you'll be saving a good $1,000 per year because they lowered that. So it's not an interest rate change, but it is something that directly impacts your mortgage payment, because of course the mortgage insurance premium goes directly into that mortgage payment. And I don't know how they did it on the veterans, but something is apparently changed on the VA loan also, where their payments related to the insuring or guaranteeing of the loan have also been lowered. But I don't know the details on that one.
Well, I'm going to try to take one more for the evening. And then I see a lot of you guys have a lot of questions on this. Can Sachs talk about the LLPA adjustment next week or so after it takes effect, which is May 1. So we'll be getting more information. And when Todd is back next week, we will definitely be having some conversation about that and taking your questions about that as well. But Ron, thank you so much for being our guest tonight.
Glad to step in for Todd. I know everybody looks forward to seeing him, but he'll be back. And sorry we didn't answer all your questions, but hopefully we gave you some good information on many of them.
Yeah. And thank you guys always for tuning in on every Tuesday night. As always, like, subscribe, and click the bell, and share this with anyone who you think would benefit from this information. And until then, we will see you next week. And thank you, Ron, so much.
All right. Have a good evening, everybody.
Have a good night. Thank you.